What is liquidity? It's simple. Liquidity means how much buying and selling is happening at each price level in the market. A price level packed with buyers and sellers. Boom, high liquidity. Now flip it. Hardly anyone's there. Some prices, no buyers, no sellers, that's low liquidity. Here's the catch. Every trade needs a match. A buyer plus a seller equals trade. No match, no trade. Let's say a big player wants to buy $700,000 worth of something, but only $500,000 is available at that price. What happens? Their order eats through the price levels. Price shoots up. That's called slippage. And trust me, big players hate slippage. Why does liquidity matter? Because the big guys need lots of orders on the other side to enter without moving the price. If we can spot those liquidity pools on the chart, we've just unlocked a major edge in the game. So we want to identify the areas on our price charts where we think there is going to be large pools of resting available liquidity for institutions to use, okay? So we assume that there is liquidity behind every structural high and low in the market. Now that can come in many forms, as it's shown on the chart here, but essentially the more significant that high or low, we can assume the more available liquidity there will be behind it. Now there's a lot of sort of discretionary ways that this can appear. You got trend lines, equal highs and lows. You can have, session range liquidity, say with the Asian session range, previous day highs and lows, right? There's lots of different ways that traders like to use. And that's why you'll see in other YouTube videos, traders will just draw liquidity everywhere now, whilst that might be factually true. How does it help you with your trading, right? You want to make it as systematic, refined, and mechanical as possible. So what I would advise to you when you're starting out is just focus on something like the strong high and low concept, because this is extremely mechanical and simple to identify. Now behind these highs, we assume that there is buy-side liquidity, and below these lows, we assume there is sell-side liquidity, okay? Now why do we get these liquidity pools forming behind these structural points in the market? Well, that's where the concept of inducement comes in. Inducement is something that persuades or leads someone to do something. In trading, what that essentially means is that patterns in the market encourage market participants to trade at certain levels. This, in turn, generates available liquidity for the big players to use in order to fill their positions. For instance, imagine you get equal lows in the market, those double bottoms. What does that form? It forms a support level that traders might want to buy from. If they're buying at that support level, where are they going to place their stop loss? Right, below the lows. That generates sell-side liquidity. Likewise, some people might view that double bottom as a bear flag, expecting a breakdown and wanting to sell the breakout. That, again, leads to more sell-side liquidity building up below those lows. Or, say you get a low that breaks a previous high. Traders may now interpret this as the start of a bullish trend. So, they want to buy there, hoping the trend continues upward. And where will they place their stop loss? Below the low. Again, generating sell-side liquidity. You get the opposite for bearish patterns, which generate buy-side liquidity above the highs. So again, what are we doing here? Institutions need opposing liquidity to fill their orders. If you look for these patterns in areas on your chart where you're expecting a certain direction to play out, for example, if you identify a high probability supply zone and start seeing structural highs form in front of it, then you know there is buy-side liquidity for the big players to sell against. They need that opposing liquidity to enter the market short with minimal slippage. The key here is identifying inducement that generates available liquidity. For instance, structure forming in front of a POI, point of interest, can increase the probability of it holding and of price playing out in the direction you're anticipating. This is a powerful concept when understood properly, but on its own, it's pretty useless. Like anything in trading, you need to combine it with your other confluences to build a portfolio of evidence and take high probability trades. So now we understand what liquidity is, where we can find it on our charts, and why institutions need it. But now the question is, how can we use all of that to actually make money? If I can simplify it for you, there are two main ways we use liquidity. Looking at the past, we look for where sweeps have already occurred. This helps signal that institutional activity may have taken place there. Anticipating the future, we identify where liquidity is currently available to anticipate whether institutions might enter those same areas again. So the first part is asking, where have they previously entered? That's where the concept of liquidity sweep zones comes into play. If you find a supply or demand zone that took liquidity during its formation, that can signal that institutions were involved in creating that zone. Why? What's the logic behind this? Well, if we assume there is buy-side liquidity above a high, that means institutions can use that liquidity to sell against. It helps them fill large orders with minimal slippage during the formation of that zone. There are different ways in which this can form. For example, if we see a zone that took out a low during the creation of a demand zone, that could mean buyers use the sell-side liquidity to enter long positions. Now, you can use this as a filter to look for higher probability zones within your trading strategy. Now we know that in a bullish market, lows are strong because they create those highs and break structure to the upside. What you'll often notice is that these strong lows in a bullish market are created through sweeps of liquidity. Why? Because institutions need the sell-side liquidity below those lows in order to fill their long positions, to fuel that next pro-trend run to the upside. Okay, so if you look here, you'll see that every time a swing pullback completes, it happens through a strong liquidation. We take out liquidity from the leg to the left. We even get a low here that then breaks a high, generating strong available liquidity below that low. The big players can then use that to get long and fuel the next move up. You'll see this again and again. Every low takes liquidity when it's formed. Again, we come down, take liquidity during the formation of the zone. If I zoom in here a bit, sometimes it's a bit more subtle, but we get this supply to demand flip. It takes liquidity to fuel that next move up. Okay, maybe not quite enough to break structure yet, but then we come down, grab the liquidity into this POI, and we get that next move to the upside. And you'll see this pattern time and time again. Liquidity sweep before the next leg up. Here again, equal lows into our POI, increasing the probability that the next strong piece of structure is about to form. Rinse and repeat. So, identifying zones that form through liquidity sweeps is a great signal that there was institutional involvement. When you're trying to refine the potential zones you want to trade from in the future, those are great areas to look at. So that's looking at the past. Now let's look into the future and ask, where is the available liquidity that institutions may potentially use? Because that is what we can use to align our trades with the market direction. Let's take a look at that. So, sweep zones show us where institutions may have previously entered. The concept of inducement shows us where the available liquidity is, in case they plan to enter again. Okay, so if there's no available liquidity to the left, no structural low to the left, and nothing built to the right, meaning no structural lows there either, then where is the available liquidity? It's going to be behind the zone itself, and that's often when you'll see zones fail. Here's an example. No liquidity to the left, nothing built to the right. The only available liquidity for the against is behind the POI itself. And that's where you'll see the trap. The zone gets swept. Now, on this occasion, the top zone doesn't have any liquidity to the left and nothing to the right either. So, again, the available liquidity is behind that zone. Institutions can then use that sell-side liquidity to get long from the previous zone, which increases the probability that this becomes the POI that breaks out. We can see that clearly here. This zone down here had no liquidity to the left and nothing built to the right. So that ends up liquidity for the extreme POI. That's the one that holds, and then the move happens. So what if there's no available liquidity to the left? We can sometimes see it build to the right. Here, there's no immediate structural low in the leg to the left, but we see those clear equal lows that also broke structure, built to the right. Now, there's available liquidity for those long positions to be filled. Ideally, you want liquidity on both sides, on the left and on the right, and that gives you a high probability POI. Now, you need to systemize this. You need to know exactly what your mechanical definition is for when and where inducement builds. You need mechanical rules for that. How close to your POI does it need to be? When is it relevant and when is it not? What time frames is it relevant on? Can you use it on your lower time frames? In which phases of the market does it apply? These are all things that need to be as systematic as possible, and that's exactly what we've done in our trade plans. Our community knows what to do in every scenario. They have exact mechanical rules for all of this, because otherwise, you'll end up justifying every single move in the market, and that leads to inconsistent actions and inconsistent results. We need to systemize it. Okay, so quick example here on the chart. We're clearly in a bearish market. Now, as price comes into this zone here, what do we notice? A straight push, no liquidity in the leg, no strong liquidity is built to the right. None of these highs break lows. So what ends up happening? The only available liquidity is behind the zone itself. We see this high and this high get swept, and that eventually produces enough buy-side liquidity for the big players to sell against, to fuel that next movement to the downside, right? Then we get a new structural range to work within. Cool. Now we want to try and capture those shorts. We've got one zone here and then the extreme zone down here. What do we look for with our liquidity requirements? This is a straight push. There's no structural high in the leg. Nothing significant is built to the right, based on the rules we use. So where's the available liquidity? It's behind the zone itself. That acts as the inducement for the extreme zone, and eventually we get the move to the downside. Okay, now we get some corrective Asia price action coming into London the next day. Let's zoom in. We can see here a nice supply chain forming, but again, no available liquidity in the leg. So what builds to the right? We get a high that breaks a low. What What does that do? It induces buy-side liquidity behind that strong high, increasing the probability of institutional shorting potentially from there to fuel the next move down. Okay, we get another break of structure. Here's our new structural range to work within. Now we have a zone here, but what do you notice? Again, a straight push. There's no available liquidity in this leg, so what do we need to see? We need to see strong liquidity built in the pullback to increase the probability that this zone might hold. Otherwise, where is the available liquidity? It's behind the high itself. So what ends up happening? That high gets swept, and now there's enough fuel to drive the move to the downside. No liquidity to the left, nothing built to the right. That high gets swept, and now the big guys can get short, using that buy-side liquidity to fuel the next leg. You're starting to see now how all of that logic ties together to help you formulate trade ideas, to help increase the probability of what you expect. But again, you need to combine this with all the other elements in your trading. This alone isn't going to solve your trading. We are looking at an entry model setup. For example, this is an M15 chart, and it's currently bullish. There's a strong demand zone, and we can see a clear impulsive move with inducement. This kind of setup is called a leg inducement, because the inducement happens during the impulse leg itself. Now, price pulls back and taps into the demand zone, while also collecting liquidity from the inducement that was sitting to the side. At this point, we shift down to the lower time frame, 1 minute. On the 1-minute chart, we see a fractal change of character, a signal that momentum may be shifting back upward. A new demand zone becomes available, and this is where we look to enter a buy position. We place our stop loss just below the M15 demand zone, and for the target, we aim for the M15 week high. And just like that, target hit. Thank you for watching. See you next video.